Walter here. Glad to have you here. We're going to talk about calculating risk and, more importantly, calculating the likelihood that you're going to quit your trading. The number one killer, really, which is it's a risk-based thing. We know there are three things with our trading that help us achieve consistent profits. Number one, you have a trading system that fits your beliefs. You have a trading system that makes money. That's the system, number one. Number two, your risk management rules enable you to achieve your profit goals and to avoid your goals in terms of survival, which is really what we're going to talk about today. It's really number two, risk. And number three is the psychology. Psychology involved in trading is basically essentially dealing with the emotions that try and get you off track and also keeping on track, which is more of an execution point of view. So that's the psychology. So three things: your system, your risk rules, your psychology. Right now we're going to talk about number two, and I'm going to share with you how to do this. So let's do it. I know the screen's going to get all funky there for a second, but now I think we are on. Oh, yes, we are. Okay, so what you're looking at here is an account of $60,112.98. We risk 2% on this account, and let's say that we're trading the Aussie yen. So the way that this works, and by the way, I'll give you the, you can get the link to this spreadsheet. I'll give it to you below this video so you can get that. This is the sort of thing that we'll be using in the Small Account Big Profits course. So if this interests you, if this sort of approach to trading interests you, you may want to join us in Small Accounts Big Profits. And that link is below or above this video, most likely. All right, so let's talk about how you do this. So I go, all right, I want to trade the Aussie yen. Let's say that I have an Aussie account, all right? So I've got an Aussie account. I want to trade the Aussie yen. And the current price is $79.30. It's really close to that anyway. I just checked it. So I say, all right, and let's say that I've got a micro lot account. So I'm looking at $1,000 lots rather than 100,000. A standard lot's 100,000, and I've got $1,000 lots. So I go, okay, what would be my pip value? And this is going to calculate it for me. You can just look up a pip calculator on the internet, and they're all pretty similar. And so you can see here that the pip value is 13 cents. So each pip movement up and down on the Aussie yen is worth 13 cents. So what I do then is I plug that bad boy in here like so. And then I go, well, if I'm going to buy Aussie yen, actually, let's say I'm going to sell. I'm going to sell Aussie yen at 79.30. And my stop loss, I'm going to put that bad boy up there at 79.70, 79.80, 50 pips away. Then what that's telling me is I can trade to risk 2% of a $60,112.98 account. My risk amount is $1,202.26. So I should be risking 184 micro lots, right? That's what that is telling me. And that's it. That's all it's telling me. And it'd be 18 mini lots or 1.8 standard lots. And that's how that works. So really the thing to keep in mind here is that you need to, number one, know what the pip value is. And then with this calculator, you just choose whether it's a yen pair or like a standard pair, because the calculation is obviously different with the yen pairs. They have more different decimal placement, essentially. So let's talk about the second thing that I wanted to share with you, which is really important. And this is, how do I know if I'm going to blow up my system and quit trading it, or even quit trading altogether? The way that you do this, you use the risk calculator, also linked up underneath this video. And so let's say I have a 48% win rate and my reward risk ratio is 2-to-1, which is not very good, but I would rather trade a lower win rate, higher reward risk ratio strategy. But anyway, let's just say that's what we've got. And then I say, okay, I'm risking 2%. And I want to know over the next 10,000 trades if I'm likely to have a drawdown of 20%, because that's the amount that I want to avoid. So that's what this is all this is the whole thing just going to tell me, yes, I have a 100% chance of having a 20% drawdown given me my system parameters. So I've got to change this. This is the easiest way to change that. So if I risk 1% per trade, I only have about 11 to 10 to 8 to 11% chance of hitting that 20% drawdown, which is still too much. So I'm going to go down to 0.75 or 0.75% per trade, and we can get that down to under 1%, which may be acceptable. And that's the way that I can use my system parameters. All I need to know is what is the reward risk ratio, which is basically your average winner divided by your average loser. And then what is my win rate? And then what is the amount that the drawdown percentage that I don't want to have? I don't want to hit that. And then I can adjust my risk per trade given that. Of course, you now know how to do your risk per trade using the risk calculator, so you're good to go. So I hope that helps. I wish you very happy trading. Thanks so much for spending time here. Hope to see you in the Small Account Big Profits course. If this style of trading is something that you want to do, we're going to take a small account and ramp it up as quickly as we can. I wish you happy trading, and we'll see you in another video. Take care. See ya. Bye.